Good morning and good afternoon, guys. This is Sunday, the 29th of January 2017. Now, this is going to be quite an in-depth video discussing housing, because generally this is not only the largest purchase people normally make in their lifetime, it's also something that people need to understand where exactly we are in this cycle of events in order to educate yourself with the evidence provided whether now is actually a good time to be purchasing a home, or whether it might be more prudent to rent and wait. Now before I get started into this article, something we need to obviously understand is that people are brought up through different generations, and with that comes different mindsets about property as investments. And before I even go down the investment route, I am no financial advisor, and you will have to make your own due diligence on anything that you decide to do. But I'm only here sharing my thoughts and views to hopefully help people in how I see things. So we've had various bull and bubble markets that have occurred throughout the global housing markets. We have had huge creations of monetary stimulus, which has had a direct effect into our housing markets, especially over here in the West. So first of all, for all those who subscribe to my channel because you're interested in silver, this is going to be relevant to you. To all those who subscribe to my channel regarding political events, this is going to be relevant to you. To all those people who are interested in maximizing any form of asset you have, this is going to be relevant to you. For all those who want to understand market cycles and bubbles and using those cycles to benefit you, this will be relevant to you also. And for those who just want some information specifically in the UK housing industry, and I will be putting reference in to other countries, this will be relevant to you. So let's start off with this image here, which I think is a great analogy of many people that literally have their head in the sand. Today, I place a bubble of happiness around myself, and nothing negative can get in. And many people live their lives inside of this safe bubble, ignorant to what is going on around them. So what is another example of a bubble? Well, quite simply, it could be a housing bubble. And following on from a housing bubble, what creates a housing bubble? Well, it's an economic bubble with injection of inflation flooding into the markets with speculative buyers inflating those prices. And a lot of wealth is transferred into asset form because the people who hold the wealth and the money put a lot of it into bricks and mortars because it generates higher yields, especially in current market systems, because it generates a passive income for those lucky, wealthy people who can acquire vast amounts of real estate in American terms and property markets and commercial sectors in the UK. But what happens when there's all this liquidity flooding in to these markets? Well, it's very simple. It creates a housing bubble. Now, this is all fundamental and easy things to understand, but something that you may not fully grasp is why the housing prices are rising so fast that people are scrambling to try and get onto these market ladders before they become unreachable. What is the driving factor that is creating this? Well, it's the creation of money. It's the injection of fiat currencies through all the global markets, through all the global countries, because none of them are backed by any physical measure, limiting the paper printing creation of fiat currencies. Every single day, at the current rates, quantitative easing is being printed to oblivion in the Western world. This is having a direct effect on the housing markets, because when print into oblivion is taking place, the monetary value depreciates because there's more creation of money in circulation. Supposedly in circulation, although it's not actually in circulation. It's normally propping up the top tier level investments like stocks and bonds, and propping up all the critical areas of infrastructure that is keeping this bubble inflated. None of this creation of money is trickling down the average family. So let's see what the exact definition is of a bubble. What is a bubble? A bubble is an economic cycle characterized by rapid escalation of asset prices followed by a contraction. It is created by a surge in asset prices unwarranted by the fundamentals of the asset and driven by exuberant market behavior. When no more investors are willing to buy at the elevated price, a massive sell-off occurs, causing the bubble to deflate. So a recap of a recent bubble is the history, which includes two of the most consequential bubbles, the dot-com bubble of the 1990s and the housing bubble of 2007 to 2008. However, the first recorded speculative bubble, which occurred in Holland from 1634 to 1637, provides an illustrative lesson that applies to this day. And for those of you not aware of the 1634 bubble, that was titled Tulip Mania, where tulips, which is the bulb that grows into a small plant, were trading for the same value as houses in today's market. Why? Because the bubble that people believed these things would continue to sell for higher and higher prices, all because they believed it, until one day this whole market collapsed spectacularly, leaving thousands and thousands of people severely burnt by overpaying for a simple bulb. But one thing that people have a difficulty grasping is the fact that they live in a bubble. And it's one of those catch-22 situations where those inside of bubbles can't see outside of the bubble. They believe that the system, due to the multi-decade rise, will have the same effect for the indefinite future. But what they fail to grasp is that the whole monetary stimulus package that created that deflationary effect of the value of their currency to inflate the perceived value of that property is inside of another bubble, and that it has been built upon on lies and unbacked securities as the greatest Ponzi scheme that has ever been created. And that is the housing market of today. This is only a small bubble inside of the larger bubble. And when I talk about the larger bubble, that is the whole derivative, financial, banking and stock market Ponzi scheme that is in a hyper bubble. Now, regardless of what you think about that statement, it is reality. You only have to do a little bit of research to discover that. So now that we understand those few words, and subject to which era you were raised in, you'll be saying to yourself now one of two things. You either agree with that statement and you can see that there is a housing bubble, but you will not agree that this market is going to collapse. You will not agree that this economic system has an expiry date. And then there'll be those of you who do agree and you actually get this and you understand this. And it's you guys that I'm talking to. Now, one thing we need to understand about currency systems is once upon a time they used to be backed by a physical commodity like gold or silver. And that has helped keep inflation at bay. That has helped maintain a steady value of properties, of wages, and of the value of any money that you save for your retirements in regards to its purchasing power when it comes time that you require it. Today, there is no gold backing. Today, there is no silver backing. Today, there is only fiat currencies, which get devalued by the day. You may not notice it, but every single week, shopping bills become more expensive, energy costs become more expensive, Your wages remain either stagnant, or even if they do appear to be slowly increasing due to governmental agencies coming out increasing the minimum wages, well, these small increases are no way near the levels of inflation that are occurring. And inflation cannot be measured by governmental statistics because these are manipulated numbers in order to make inflation look lower than it really is. All part of a deception plan. And this is all part of the trap of poverty, making you poorer over time. And that can be reflected with ever increasing taxes. Okay, so getting back onto topic regarding housing inside of the UK. We have this article. Now that we understand what exactly is currencies and what exactly is a bubble market. This article from the Telegraph.co.uk titled Fears of a Massive Global Property Price Fall Amid Dangerous Conditions and Market Slowdown. And this is published on the 2nd of January 2017. Property prices have climbed to dangerous levels in several advanced economies, raising the risk of massive price falls if markets overheat. Catherine Mann, the OECD's chief economist, said the think tank was monitoring, quote, vulnerabilities in asset markets, end quote, closely amid predictions of higher inflation and the prospect of divergent monetary policies next year. So as we know, guys, think tanks then sit around and analyze manipulated markets to predict what the outcomes are going to be, generally backed by rich billionaires or governmental entities, with the overall objective of continuing the manipulation or understanding economics to manipulate it further for future objectives. So she's talking about predictions of higher inflation. Well, I'll tell you something for nothing. There is no prediction about it. That is a guaranteed certainty in this current cycle due to the printing of oblivion of all Western currencies via quantitative easing and market stimulus and various ideas and schemes that they come up with in order to help people take out further debt in order to keep this bubble propped up. So she also comes out with a second section, which is the prospect of divergent monetary policies next year. So divergent means the outflow, quite likely, of money. And that will be covered shortly because it relates to Brexit. A quote number of countries, end quote, including Canada and Sweden, had quote very high, end quote, commercial and residential property prices that were quote not consistent with a stable real estate market, end quote. And obviously I've done a video previously on the Canada situation, and obviously a lot of the Chinese have been acquiring homes in Canada in order to get their money out of the massively depreciating Chinese yuan. And this has been happening in places like Vancouver, where prices have rocketed in value during the last few years due to China having something like 300 million people in the middle class sector, which is a tremendous amount of cash that they are trying to preserve due to the nature of instability in the Chinese yuan currently. And it is all about currency wars, guys. Currency wars. Because if your currency is cheaper than another value, then you can market your goods at a cheaper value. So we take a quick look down at this chart here. House prices in some advanced economies are growing rapidly. And I'll be totally honest with you guys, I don't think this is an entirely accurate chart, because I'll back this up in just a moment. But it shows quite simply the rise and falls during certain eras, which is why I'm referencing to this now. Because on general terms, we have here, which is the UK in this sort of orangey colour, having a peak in the region of 2007, which we know, which was just before the 2008 crash. And as you can see, the crash hit and dropped, as per this chart, from 165 down to 132, which I'm guessing is representing the average house price, which by my understanding is total crap. But nonetheless, you can see the flow on the chart of the peak and of the lows. So this correction supposedly represented a 15% decrease in value during the crash cycle, which all the pundits and medias painted as a horrendous time. But when you actually look at it in market term value, what's a 15% correction when we actually go back and view it on a longer term cycle, which I will do shortly. But anyway, this is just the UK. So 2007 was the peak, and as per this chart, we're now pretty much at, as of 2015, back at the same levels. However, in places like New Zealand, where pre-2008 it was floating at 191, it's now at 242. Similar with Sweden and Canada and Australia. It doesn't take much to see that during these crash periods of 2008, all these major Western nations have regained back to all-time highs and surpassed it. And this is all obviously during what was in 2007 a bull market with nothing more than a natural correction which was artificially supported to prop and stimulate the markets back up to give the artificial impression of wealth. It goes on to say, property price falls in Britain following the vote to leave the EU could, quote, be good for the UK, end quote, which obviously, guys, price falls are required in a natural, healthy market. You can't have endless bull runs because it's not a natural cycle. There's no realization in the market. It's just plain and simple artificial. If the market adjustment is borne mainly by foreign investors. So she's saying it's absolutely fine to have a market correction in the UK as long as the UK people don't lose their perceived wealth in property value. We're happy as long as it's foreign investors that lose. And as we'll see shortly, that actually represents a 50-50 split near enough. But we'll cover that shortly. Quote, we've already started to see some changes in real estate prices in the UK. Housing prices, guys. It's like it's like an article for the UK apart from it's using Americanism terms. Anyway, particularly in the London market, because London is the highest average home price in the UK, simply because obviously it's the capital and all the business interest is inside of London. So anything close to there obviously holds that premium charge. What's interesting in terms of implications for the UK economy is who bears the burden. Who bears the adjustment cost? If it is a non-resident, then lower house prices could actually be good for the UK. So if there's foreign people that have invested inside the UK, it's acceptable for them to lose capital on their investments, according to her. So guys, if we check out this chart here, this is what I was talking about, the 15% drop. Are house prices on the up? Annual change in house prices according to the ONS House Price Index. And this is going from 2006 through to 2016. So as we're aware, we were hitting a very large bull market and housing spike prior to the 2007 crisis, where it sharply hit a 10% gain year on year average, which was the peak of 2007, followed by a 15% decline in the value of the home, which lasted for 2 years, coming out in 2010, regaining back up to a 10% year-on-year average, followed by pretty much flat for the next 2 to 3 years while markets were repricing themselves. Because obviously after any dip in the market, there's always a lot of money that then floods back into the market as a speculative flipper will be coming in at this stage here to then flip the market, to then flip the home very quickly. Because as with any governmental objective, they need to inflate the markets because so many wealthy oligarchs own vast amounts of property, both commercial and residential. So it's in the interests of the oligarch elites to stimulate housing markets and properties because that their form of wealth and also business. And then obviously comes the realization where there's a fluctuation occurring for the next couple of years while it's finding its feet and market stimulus is recurring. But something that is lost during this whole section here for a 4-year period is people's confidence in the markets. So that takes time for people's confidence to understand what exactly is going on, a realization phase. And once people realized these markets are protected, they're being stimulated and they're being propped up, what happens when a market continues to grow again, as it has done? In January 2016, 41.5% of homes for sale in London were sold above the asking price. And to me, that is just absolute bonkers, which shows that simply bidding wars take place. More buyers than there are sellers. As we all know, there are more buyers, and there is way more liquid capital funds inside of hedge funds, inside of property asset acquisition firms, and obviously not forgetting the regular million and billionaire investors that just have way too much cash that they need to burn and get rid of. But this fell to just 23% in November. So still, a quarter of all homes had a bidding war in London as of November 2016. Nationally, the fall was less steep, from 29.8% in March to 23.1% in November. So still, roughly, a quarter of homes in the UK are still having a bidding war occur, which tells you one thing: this is not really a cooling down market as this article reads, because there is still people offering more than the asking price. It goes on to say, while prices did not fall across the country last year, there was a slowdown in activity as people chose not to buy a home. And I find that an interesting set of words, because I'll be blatantly honest, people don't have the ability to buy a home, let alone the choice. There is only a very select few of people who have the ability. Quote, there isn't the same level of competition in the market now, end quote. New buyer inquiries have been at very low levels in the second half of the year. The number of new properties on the market has also been on a record low, helping to prop up prices. It's the age-old supply and demand, especially with the influx of immigration that is occurring inside the UK, with the added help of governments and councils giving properties to migrants and refugees, knowing full well that this has a direct impact on the housing supply, driving up anybody that needs a roof over their heads, because at the end of the day, that is something that every person needs, a roof over their heads. So with the effective native people competing with the immigration that is flooding into the countries, and we're talking by the hundreds of thousands a year, all over Europe and America, this has a direct impact on property prices. Again, playing into the favour of those who benefit from the rental market. Quote, we expect prices to fall next year as this slowdown works through the system. So the anticipation that is coming out from this Telegraph article is that because there is a slowdown in inquiries, because the reality is people don't have the money, they are expecting that property prices are to slow down. But to the contrary, if a recession doesn't hit, then this is not going to occur. Because as we know, people towards the top of the chain are getting richer and richer, while the people at the bottom are getting poorer and poorer. So with the increased ability of people with vast access to hundreds of thousands and millions of pounds per year of available capital to invest, what are they going to be spending that capital on? Especially if they are in a competing market against other millionaires, other billionaires. It reminds me of the game Monopoly, and that is exactly what is occurring. And that is exactly what is being orchestrated by a government. So what's interesting here is this next section. Generally, the first thing to change will be the number of transactions. And then after, the gap between what people will pay and how much people will accept. And this is something that people need to understand when they're inside of their bubble existence and they can't see outside, because this is the reality of what happens in a market correction. Because people get the great idea that their property is worth what they think it is worth because somebody says it is worth it, and they will not sell it for anything less, but only more, because that's where greed comes into it, and the delusional aspect of what the quote market predicts that price to be. But what they don't understand is the realization phase during a collapsing market, and how the buyer, and especially cash, is king. So again, generally the first thing to change will be the number of transactions. So this will happen during a market reset. It takes time for this to be accepted throughout the market, but the transactions will drop off because nobody will be wanting to buy during the devaluation phase. People will be wanting to sell, and people may even be getting desperate to sell, but yet many people will be holding off because they see the prices are tumbling thousands of pounds per day, per week. So those people with cash available are prudent enough to know until there is literally blood in the streets and prices are dirt cheap. You'll obviously have people that are acquiring during a 15% correction, a 25% correction. But as I'll go on to explain later, you should be expecting to see at least a 50% correction, if not more. And that all comes in the realization phase, after the gap between what people will pay and how much people will accept. And it really comes down to the people that will accept realizing that the value of their home is worth nowhere near their perceived amount inside of their head, inside of their bubble. So that bubble will burst, and then they will slowly accept, and sales will grow. That is price adjustment. So carrying on, the EU's financial risk watchdog recently warned that 8 countries, including the UK, risked overheating in the environment at low interest rates. And as we know, guys, in the UK, interest rates for mortgages and things like that are floating around the 3% mark, which I believe is almost unparalleled in history, simply due to the ever increasing debt levels. And the reason they're so low is to stimulate the market. But in a flip of events, that 3% can rise to 15%. And that is when people find themselves in extreme difficulty in trying to repay mortgage loans, especially with job instabilities, which will likely occur during such said time. Like it hints at here, the 2008 crisis. Well guys, the 2008 crisis is actually going to be nothing compared to the reality that will be coming to us soon. As to how soon, that is only left to speculation at the moment, but it is a mathematical certainty that the current system of debt cannot sustain itself. So again, this is the chart reverting back to the origins of buyers of property in London's West End. So it's just over 50%, but 58% are UK-based buyers, leaving 42% being from the rest of the world. And this is what Miss Mann is referring to regarding, oh, it's okay if external investors lose capital on their investments. But what she's actually missing there is, well, if that's the case, it actually also affects 58% of investors from the UK. And the housing market doesn't discriminate, it affects everyone. And the thing about London is, obviously London is the central point where then markets further out on that ripple line get affected soon after prices are reflected inside of central London. Much like if you throw a stone into a pond, it starts off with a small ripple in the centre, which then expands and expands and expands. That is exactly how it occurs through the housing market. It takes time to reach various aspects and areas, but it will reach them. So finally down here was also monitoring the potential impact of a stronger US dollar on emerging market economies, particularly those with large shares of dollar-denominated debt. And believe it or not, there are many emerging markets that have vast amounts of US dollars in order to create stimulus and projects and developments in its nations. And this is all part of a scheme in order to create debt inside of other nations by using the US dollar and expanding the US dollar into further reaching aspects of the globe. These countries could see the cost of servicing their loans rise sharply if their currencies depreciate against the greenback. And as we all know, currently the US dollar is the global currency. And the reality is, every currency during a currency reset and a currency war will devalue against the global currency, the benchmark of a currency value in comparison to the US dollar. That is just the reality of the situation. So it goes without saying that these loans will sharply rise inside of these developing nations. And there's a quote here, quote, "The potential monetary policy divergences until 2018 are pretty big, and that does create vulnerabilities for emerging markets," end quote, she said. And that's pretty much what I've just elaborated on. So let me just flick over to this site here as well, which is reflecting the true value of homes, which is why I didn't trust the chart in the previous article. And it says here, via theguardian.com, prices rose by 1.7% in December 2017 alone, reaching a new all-time high of £222,000 and pushing the ratio of house prices to earnings to 5.81%, just shy of its all-time high of 5.83% in July 2007 before the financial crisis struck. So already, guys, we're at the highest price in history for the average home as of 2016. But not only that, the house price to earnings ratio again is almost at the all-time high just before the crash. So this brings me into the next aspect of where exactly are we at the moment. And this is what I want to show you. And it's this chart here. Average house price in the UK, dated back from 1952 to 2012. So the average house price is way down here, not even calculated on the chart, but probably something like £5,000 for the average house price, less than 70 years ago. Now during the next 25 years to 1970, again, it remained at a very low increase in price, sustainable at least you could say, followed by the next 20 years, which saw it massively jump up to the 35,000 mark, which you would see as a 250% increase in the value of the home. So this is the factor where monetary creation really took off and started flooding into housing markets and stimulating the perceived value of wealth. So followed by the next 20 years. And this is the stage where a lot of people now listening to this video who are in their early 30s to 40s will have been born. So this is basically the education lesson you will have received from your parents. And that is the trend throughout this phase. So we take it to the year 2000. So we're looking at this section of massively increasing prices, and we're talking doubling over a 20-year period. And the parents' philosophy to their children is buy property. It's only gonna go up in value, which, if you see these charts, looks like very good advice. But again, like I said right at the beginning of this video, they don't understand the creation of debt, which has made this artificial bubble for, say, the last 65 years, which ironically works out to be a generation. And because nobody has been severely burnt in that generation, the pass down of knowledge regarding how to play these markets and how to protect yourself, because this is a cycle, is lost. Much like, how do you make a fire in the woods? How do you catch a rabbit and eat it? That information is lost. You just go down to the supermarket and you buy it pre-packaged there on the shelf. Does that mean you no longer need to have that information? No, it's all part of a plan in order to keep people inside of a system of artificial growth, artificial knowledge, with the belief of everything that you're doing is creating wealth. This is purely a fluctuation of value. perceived in fiat currency, which if you actually look at it at the end of the day, is nothing more than slithers of paper if you're even fortunate enough to withdraw it from your banking system. And if you're not, it is nothing more than a 1 and 0 on a computer screen. Is that real wealth? No. But the issue is, most of this is now unattainable at this level for people coming into the working industry in their early 20s, 30s and 40s, because prices are just running away. So unless you are lucky to get in during this stage here, it is now pretty much unattainable, unless you are earning very high levels of income. So what happened during this 2012 patch, when the market was at its peak in 2007, and then this is the 15% correction, which supposedly was a disastrous event to occur, which obviously it wasn't pleasant for a lot of people living through it. But in the schemes of this increased bull market and bubble, does this little dip really reflect a true revert back to the mean? Because in a cycle, guys, everything reverts back to a mean. What goes up must come down. That is a natural market, which means a natural market correction would retrace back for the same period it took to rise. So if this rise, say from 1988 to 2007, was a 30-year rise, it should take 30 years to decrease. However, with such a massively bull market event, these things trigger and happen even quicker. So this could happen in a 5-year period, a retracement of more than 50% of the current value. And that is where I am predicting things will actually go, into a 50% area. So flipping over, we can see a more up-to-date version up into 2015. So this is the correction in 2007, or the tiny correction, with a retracement, a consolidation, and then a severe quantitative easing boost back up to all-time highs. This is artificial, guys. This is not a correction. And you could actually even view this as a bull and flag move, where the explosion in value could be the same projection during this phase here added onto the top. But this is extremely unlikely. And the bull flag can equally go down by the same amount. So this next image, which is the UK house price earnings to ratio, dated from 1980 to 2010. So from 1980, the UK average price to earnings, which means the average income compared to the value of the home, floated from 1980 down to 3.2%, and then in the next 5-year period shot up to 5%. And then during the next period, and then from this period of 1989 through to 1995, a 6-year period, the average home value to wage value dropped again below 3, which means for 3 full years of wages you could acquire a home. But obviously now, guys, they're talking about the value is now in the region, again, of over 5. And this trend is obviously going to continue all the while that the property prices are increasing. So although this is only dated to 2010, which there is still instability, I don't have the 2015 version, which is why younger people are finding it harder and harder to buy properties, because their price to earnings ratios aren't keeping up with the increased bubble markets of the housing market. So lastly, this image here, which is the median home sale prices by year for San Francisco, California and the United States. And this is from 1971 through to 2015. And again, right through this central area, which has been classed as Housing Bubble 1. What happened? We start with San Francisco, where the average home price was $895,000 US, which dropped to its low in 2011 of $695,000. As of 2015, April to May, that same property has doubled in value in a 4-year span, which is now valued at $1.3 million US. So this is now in a hyper bubble market with a and it's the same situation for Canada, for California, 560,000, bubble 1, dropped down to 291, and is now back up in the region of 500,000. And this is obviously in bubble cities, in the hotspots, because when you look at the average home price throughout the United States, bubble 1 was 230. After the correction of 2007, it went to 166,000, still extremely relevant in percentage terms for those trying to purchase a home. So the whole moral of this video, guys, is we are in a huge bubble. And what does that mean for, is this a good time to purchase? Knowing how things and monetary aspects affect housing prices, especially in extreme turbulent times. Would you rather be buying on the rise and at the peak, or would you rather have a 50% discount during the next crisis? But we can even take this one step further, and that will be documented in my next video titled Part 2. So please tune in for that, and I'll see you soon, guys. Thank you so much for watching. Please do share this, please do comment, and please do support this channel if you have found this information important and relevant. Options are down in the description bar, and any donations are extremely welcomed, and I thank you very much. Have a good day.